Hi, I'm Paul Guest, Global Capital Markets Research Director at Jones Lang LaSalle. I'm going to talk to you a little bit about the first quarter results for the real estate investment market globally. The market got off to a great start in 2011. We had about $94 billion in direct commercial real estate transactions during that three-month period. Let me just clarify what we're talking about here. We're talking about direct investable real estate. So we're not including land or development or residential. This is offices, retail space, logistics space, hotels that's traded hands around the world. So about $94 billion in the first quarter. That's up over 40% from the same 3 months of 2010, but is actually down about 20% from the previous quarter. Now that's normal. The rush to complete deals in the final months of the year in the Americas and in Europe means that the fourth quarter is usually the busiest of the year. So not unusual to see a downturn. Now, we did have some very surprising results during the quarter. The UK, Germany, Japan even, the US and Brazil all registered much stronger growth than we'd expected. So we had a look at our forecast for the full year, and whereas we'd been saying at the beginning of the year, we were looking for about $380 to $400 billion in transactions this year, we've revised that up to a total of $440 billion. Just to put that in some context, the peak of the market in 2007 saw $795 billion of transactions, so we're just over halfway back towards the peak. In comparison to previous years, this total puts us somewhere between 2004 and 2005 in terms of total volumes. So you're looking at partway through the recovery cycle. But interestingly, if I compare the state of the real estate investment market to the state of the economy and how quickly that's growing, we're already back at about 2008's levels, pre-Lehman. So more rapid growth than you would expect for this point of the economic cycle. And I'll tell you why. I was looking back at the numbers, and the big emerging economies, you can use the BRICS, there's a lot of other groups, the CRABs, the CIVETs, etc. But let's go with BRICS, Brazil, Russia, India, and China. In 2002, 2003, their share of direct real estate transactions was about 2 or 3%. Fast forward to the peak of the boom, you're looking at about 10% or 12%, depending on the quarter. So you've seen a steady secular climb over this period, an increase in their share of the real estate investment market. In Q1 2011, based on our numbers, counts for just under 13% of total transaction volumes. So what you're looking at is those secondary and tertiary markets in the US, in Europe, that transacted at the peak of the boom are flat now. They're not trading hands. What is trading hands is a whole new packet of investable property in Brazil, in China, in India, in Russia, and in other large, rapidly growing emerging economies. That trend is going to continue. So the reason why we're seeing a more active real estate investment market than we would expect in this period of the economic cycle is the more rapid growth in emerging economies. That's positive news for real estate, it's positive news for the economy as a whole, but it does bear monitoring. Prices are rising rapidly, there's a lot of competition for the same stock. So as we go into quarter 2, quarter 3, quarter 4 of this year, with those forecasts of a $440 billion market in mind, we're going to be keeping a close eye on those large emerging economies. Now you can read more about this in our Global Capital Flows report, which will be out in the first week of May. Thank you.